Well, I certainly needed yesterday's stock market performance to inject a little bit of life back into my investment portfolio. My trading 2-on-2 investment portfolio was down just over £1,800 since the start of December, and it certainly looked like my luck had run out for extremely good and profitable returns for 2021. But fortunately for me, yesterday revival struck the stock market. Some of my biggest holdings like Apple were up 3.5% at all-time highs, Tesla up 3.7%, AMD up 4.5%, and even Palantir Technologies made some gains, being up 4.2%. The S&P 500 was also up another 2%, closing back in on all-time highs, and my investment portfolio managed to recover £1,400 just in a single day. So what on earth were we all worried about? The volatility indexes went through the roof and the fear indicator went off the charts too. Now all of a sudden we're sitting back, relaxed, because our portfolios are making gains once again. But the question is, will all of this be short-lived? Is this just a dead cat bounce before we end up seeing the real market crash take place? Will this be the last opportunity to take some profits off the table before we see a big sell-off? Well, the reality is I certainly don't know the answer to that, and as it goes on the Wolf of Wall Street,
nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles, least of all stockbrokers.
But with that in mind, I think there are a couple of things that we can assume from the current state of the stock market right now. First up, the stock market has already dealt with the height of the pandemic, and you could even go on to say that the March 2020 stock market crash was simply unjustified, and it was largely just a knee-jerk reaction based on all of the uncertainty and more of the fear of the unknown at what the pandemic and the virus could potentially do. Whereas now companies have contingency plans in place left, right, and center, and as of right now, we're pretty much operating as normal. So I think on that basis, it's probably quite unlikely that the market will overreact to any kind of new variants anytime soon. There is obviously a little bit of fear left in the market, driven by the fact that when this new Omicron variant was publicized and there was a lot of fear mongering going on in the press, obviously the stock market did still have a little bit of a reaction to that, and that's probably why we saw the sell-off last week. And yes, whilst we're certainly not out of the pandemic just yet, if Boris Johnson managed to get together with all of his pals this time last year and have a Christmas party whilst everybody else in the UK was locked down because of the fear of potential impacts of the virus spreading further throughout the course of Christmas, well, moving forwards, I think we'll all be just fine. In hindsight, this slight market dip in which we saw was probably just another good opportunity to buy the dips on some of your favorite high quality stocks out there. And I think that's predominantly what everybody should be focusing on when they're a long-term investor in the stock market. Whenever and wherever there is a dip in the market due to any kind of factor out there, is probably always an opportunity to buy into some stocks at some discounted prices in order to lower your average purchase price. Because the reality is these good quality investments in which you're making over the course of the long term will always prevail with strong performance. The kind of short-term events or stock market shocks are just that. They're very much short-lived. So as a long-term investor, you shouldn't really focus all too much on the short-term changes in the stock market. The second thing to assume is that timing the market or attempting to time the market is probably not the best play. If you didn't invest in the market over the course of the past couple of days whilst it was down a few percent because you thought it could go down lower, well, you then went on to miss out on probably one of the best days that the stock market has seen throughout the course of this year so far. And if you continually miss out on the best performing single days in the stock market over the course of the long term, your investment returns will be absolutely shot to pieces. According to JP Morgan, if you'd missed just the best 20 days of stock market returns over the course of the past 20 years, your return on investment would just be above break even, which is absolutely insane considering the S&P 500 has returned over 200% to investors since the point in time of the study. And look, don't take it from me, take it from one of the best in the business, Ray Dalio, who did an interview with CNBC just a couple of days ago, which I wanted to share just a short clip with you guys, where he talks all things investing in the stock market and market timing too.
To say, here's the stock market, and I'm going to time the movement into the market. I'm going to time the movement out of the market. Okay, you know what that means? Okay, you're going to guess what the next variant move is and what the next other thing is. A lot of things depend on a lot of other things, and the world and everything readjusts. What has to happen, I think, is investors, most importantly, have to realize two things. First, that cash is not a safe investment. is not a safe place because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So A, stay out of that. And then B, know how to balance a portfolio, because the way portfolios work, it's almost like for some part, something happens, another thing happens. In other words, what you can see in the markets today is that, let's say when equities go down because growth expectations falter and there's a greater likelihood of easing, then you see the bond market go up. And when you see other markets, gold, you're seeing, watch the market action on every day, and you could see those relationships. But wealth is not destroyed as much as it is transferred. And if you know how to balance those investments, we do it in what we call an all-weather portfolio. But if you know how to balance those investments, that's the most important thing. Be in a safe, well-balanced portfolio. You can reduce your risk without reducing your return. And you will not market time this, because even if you were a great market timer, the things that are happening can change the world, so it changes what should be priced into the markets.
So two very interesting things to call out here. First is simply do not bother trying to time the market because it's a fool's game. The second thing being that always try and make sure that your investment portfolio is well balanced. If you're absolutely all in on kind of major high growth stocks within your investment portfolio, you can certainly expect to have a hell of a volatile investment portfolio throughout the course of your investing lifetime. On some days, your returns will be absolutely through the roof, but then on other days, your investment returns will be absolutely through the floor. It's where the likes of Cathie Wood managed to make a name for herself back in 2020, investing into very good performing high growth stocks. And as a result of the 2020 bull market, ARK Investments management assets grew 11-fold to $34.5 billion. That's of course very impressive stuff, but 2021 has been quite the opposite. It's certainly been a little bit more of a challenging year for growth stocks, and because of that, it's severely impacted the growth of Cathie Wood's portfolio. In actual fact, Cathie Wood's fund is currently sat at 13-month lows, whereas the broader market is still up nearly 27%. So Cathie Wood's funds, on the other hand, have taken an absolute beating in comparison. That's why I simply have my investment portfolio in a mixture of big tech stocks. Obviously, I have a couple of high growth plays in there too, as well as a big exposure to just a well-diversified ETF in the S&P 500. Now, I'm by no means a portfolio expert, but the way in which I have mine, with probably about a 40% holding to just diversified ETFs like the S&P 500, provides just consistent returns over time with kind of less rates of volatility within it. So that certainly might be something to consider, as Ray Dalio said, with the current state of the stock market and the current conditions in which we face. So that said, guys, be sure to let me know your thoughts on the stock market down in the comments section below. Let me know what you think the stock market is going to do over the course of the coming months ahead into 2022. Are we going to see a big stock market crash, or will a bull market continue to go on throughout the course of next year as well? And if you did enjoy the video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.